Gold has this almost mythical reputation, and for centuries it's been considered the ultimate safe haven. Wars, recessions, political upheavals. Whenever uncertainty strikes, people turn to gold. And it's seen as a store of value, something tangible and reliable when everything else feels like it's falling apart. That's what drew me to it in the first place. Now, back in 2016, during the US presidential election, I decided to buy gold. I was certain Donald Trump's win would shake the markets with uncertainty, fear, and all of that. Everyone says gold is the go-to safe haven, so I thought I was being smart, but guess what? Gold didn't actually rally like I expected, and instead it barely moved and then it dropped. At first, I thought I'd made a mistake, but then I started digging into the history of gold, and it made more sense. And it turns out this wasn't the first time something like this happened. Take 2008, for example. During the financial crisis, when the stock market collapsed, you would have thought that gold would skyrocket as everyone rushed to safety, but it didn't. Not at first, anyway. And gold's price fell alongside the S&P 500. Well, why? And the ultimate thing is liquidity. So during times of crisis, people and institutions need cash, whether it's to cover losses, pay off debt, or just keep afloat. They sell what they can, including gold. That selling pressure can push gold prices down temporarily, and that's what happened in 2008. For a while, gold and the stock market moved in the same direction, down. But, and this is the important part, gold didn't stay down for long. After the initial panic, it started climbing, and by 2011, it hit record highs. That pattern stuck with me. When I looked back at my own experience in 2016, the uncertainty of Trump's win didn't cause an immediate surge in gold. Markets adapted, and the so-called fear trade I was banking on didn't really materialise the way I thought it would. So, what's the lesson here for retail traders like us? Well, first, gold's not as simple as crisis equals rally. Timing really does matter. And in the early stages of uncertainty or a market crash, gold actually might dip because of liquidity needs. But over the long term, it often bounces back and shines when inflation or economic instability sticks around. Second, gold works best as part of a broader strategy. I learned not just to rely on one narrative like uncertainty equals gold rally. Instead, I started paying attention to other signals, just like the commitment to trader reports. And these show how institutional traders are positioning themselves, which I think can give you a real insight into future price moves. Fundamentals also really matter in this case, things like central bank activity, interest rates, and inflation trends. Gold doesn't move in a vacuum. It's so crucial to try and tie everything together. And finally, we have to execute some kind of patience, and context is really key. Gold's short-term moves can be very unpredictable, but when you try and combine technicals, fundamentals, and sentiment analysis, you can start to picture what's going on. And it's important to make informed decisions and not just react to what's going on. Looking back, I don't regret buying gold in 2016. It was actually a really good learning experience for me. I realised that gold doesn't always react the way you think in the short term, but when you understand its patterns, you can use it to your advantage, whether it's the financial crash of 2008 or an election shock in 2016 or even 2024. Gold might stumble at first, but it actually tends to shine when it matters most.